The market was supposed to break on Friday. Instead, it exposed something far more dangerous the moment the system realized it no longer had control. There is a particular kind of quiet that settles over financial centers late on a Friday afternoon. Normally, it signals relief. Screens go dark. Positions are squared. Risk is paused. Traders leave Manhattan for the Hamptons and London for the countryside, confident that the week ended according to plan. But this weekend, the silence feels different. It is tense, heavy, unresolved. The kind of stillness you feel when something went wrong and no one is sure how bad it really is yet. What just happened in silver was never supposed to happen. According to a playbook that has been used for decades, Friday is when momentum dies. It is when rallies are capped, enthusiasm is punished, and confidence is drained before the weekend. Silver was meant to roll over. It was meant to be smashed back below resistance. The attempt was made repeatedly. Pressure hit at 65. It hit again at 66. But instead of collapsing, price absorbed every hit and surged higher into the close. When the final bell rang, silver was sitting at 67. 14, not just up, but pinned at the absolute high of the week. That number matters more than most people realize. For retail investors, it feels like validation. For institutions that have spent years leaning on short exposure, it is something closer to trade. Markets are now closed. There is no escape hatch. Anyone caught on the wrong side of this move is locked in for 48 hours, forced to watch headlines, geopolitics, and industrial demand narratives circulate while their losses remain frozen on the screen. This is not a paper cut. This is existential risk. When a market closes at the highs on a Friday, history tells us something important. The fear is not of price falling, it is of missing out. Buyers were not cautious, they were urgent. They crossed the spread, they paid up. They wanted exposure before the weekend because they understand that certain problems cannot be fixed once trading stops. To understand why this moment is so significant, you have to understand the old Friday pattern. For years, silver investors became conditioned to disappointment. A strong week would build optimism. Momentum would attract attention. Then, almost like clockwork, a heavy futures sell order would appear late Friday morning. The price would drop sharply. The weekly candle would close weak. Confidence would be broken. The message was simple. Holding silver is futile. That script ran successfully for decades, until this week. This time, the sellers fired first and failed. The dip was bought instantly. Instead of backing off into the close, buyers pressed harder. Liquidity vanished on the offer side. By the final minutes of trading, the market was being pulled upward, not pushed down. That is not normal behavior. That is a shift in market character. It tells us that the suppression mechanism is malfunctioning. The selling pressure that once overwhelmed demand no longer has enough force behind it. The banks expended their ammunition, but the buyers had more capital and more urgency. When a market closes like this, it is no longer governed by comfort, it is governed by fear of being underexposed. Now imagine being a commercial short in this environment. You sold silver at 64, expecting to buy it back lower. Instead, price is over $3 higher, and the exchange is closed. Every dollar higher represents millions in losses. You cannot hedge. You cannot exit. You can only wait and hope nothing worsens before Asia opens. And nothing ever stays quiet over a weekend. Every headline becomes a threat. Every article about industrial shortages, energy transitions, or battery demand adds pressure. Asian markets do not sleep through Western weekends. They respond to them. If silver gaps higher when trading resumes, losses instantly expand. That is why bank risk desks are running scenarios right now. Not hypotheticals, but survival math. What happens if silver opens at 68? What about 70? At what point does the loss exceed available capital? If the answer is unacceptable, there is only one solution: forced buying at the open, regardless of price. This is how violent gaps are created, not enthusiasm panic. Technically, the close above 67 changes everything. Below 65, the market spent months chopping through congestion. Sellers and buyers fought repeatedly in that zone. But above 67, history offers little resistance. There is almost no trading memory at these levels on long-term charts. That means there are no trapped holders waiting to sell into strength just to break even. Everyone left in the market is already in profit. And profitable holders behave very differently than underwater ones. They do not rush for exits. They wait. They expect continuation. This removes structural resistance entirely. What remains are psychological numbers, 70, 75, but those are not supply zones. They are mental markers. Once price enters discovery, it moves faster than most participants expect. That said, excitement without discipline is dangerous. Vertical moves attract speculation. Leverage floods in. Tourists pile on with tight stop losses and fragile conviction. These participants increase volatility and create opportunities for engineered shakeouts. A sudden $2 or $3 drop could flush out weak hands and temporarily reverse momentum. This does not negate the trend, but it tests commitment. Corrections are part of bull markets. Crashes are not. With physical supply constraints tightening and industrial demand accelerating, a structural collapse is unlikely. Any sudden drop would be the market checking who understands the difference between noise and signal. While price action dominates attention, something else is unfolding quietly behind closed doors: the weekend margin call process. Retail traders think margin calls happen instantly. Institutions operate differently. At the end of each trading day, variation margin is calculated. Losses must be covered with cash. Normally this is routine. But Friday's move was not routine. Losses ballooned beyond available liquidity for certain leverage funds. That triggers phone calls. Prime brokers are contacting clients who exceeded risk limits. The message is blunt wire: hundreds of millions by Monday morning or positions will be liquidated. It does not matter if the client believes silver will fall later. Belief is irrelevant when cash is gone. If the wire does not arrive, the broker takes control and closes the position. For a short, closing means buying immediately, aggressively, without price sensitivity. This is not a discretionary trade, it is an emergency procedure. When multiple funds face the same ultimatum, the result is a cascade. One forced buy pushes price higher, triggering margin stress in the next tier. This is how dominoes fall. The first one already tipped. Now shift focus to the physical market, where things are even tighter. Dealers operate with inventory risk. They sell metal expecting to replace it quickly at similar prices. In a fast, rising market, that assumption breaks. If you sell today and price jumps before restocking, your replacement cost exceeds your sale price. Enough of those mistakes can bankrupt a dealer. That is why many dealers freeze during sharp rallies. Websites suddenly show sold out. Checkout systems go offline. Premiums spike to levels designed to discourage buyers. This is not manipulation, it is survival. They are waiting to see if Monday confirms the move. The result is a physical vacuum. Demand surges as price rises, but supply vanishes as sellers retreat. The only way to bring metal back to market is to raise price dramatically. At the top of the system, another pressure point is forming: unallocated silver. Banks hold vast quantities of silver on behalf of wealthy clients, much of it unallocated. These are promises, not bars. Under normal conditions, clients do not ask questions. Under stress, they do. When price spikes and shortage rumors circulate, large holders request allocation. They want serial numbers, segregation, proof. If the bank has the metal, it complies. If not, it must acquire it immediately, quietly, at any price to avoid legal and reputational disaster. This creates invisible buying pressure. Banks bidding against each other to source metal they already sold claims against. Rehypothecation works until it doesn't. When trading resumes, forced buyers collide with absent sellers. That imbalance produces gaps. Price does not climb, it jumps. Shorts are filled higher than expected. Losses compound instantly, and while paper markets pause on weekends, physical metal keeps moving. Silver has weight, it travels. Right now, it is moving east. Price discrepancies between Western exchanges and Asian markets create arbitrage. When silver trades significantly higher in Shanghai than New York, metal flows toward the higher price. Refiners, logistics firms, and traders redirect shipments accordingly. Every bar sent east is one less available to settle Western contracts. This drain accelerates during market closures. While Western traders sleep, metal leaves. When markets reopen, inventories are thinner than before. Industrial buyers compound the issue. When supply is uncertain, futures contracts become useless. Manufacturers need atoms, not promises. That leads to direct procurement, long-term off-market deals with miners. Entire future production is locked up before it reaches exchanges. That silver never appears in public inventories. It bypasses price discovery entirely. This creates a split market, one visible and liquid, one private and strategic. The public sees charts and assumes availability. The private sector knows better. As a result, the quoted spot price becomes increasingly abstract. It reflects paper leverage, not physical reality. Dealers charge far above spot because replacement cost dictates price, not screens. This divergence signals stress in the pricing mechanism itself. Historically, such gaps widen before systems break. Exchange inventories tell the same story. Registered metal, available for delivery, has been declining for years. At elevated prices, more contract holders consider standing for delivery. As claims rise and inventory falls, pressure intensifies. Shorts would prefer to deliver metal rather than buy back contracts at losses. But if the metal isn't there, that option disappears. At some point, cash settlement becomes the only choice. Confidence erodes rapidly when that happens. All of this sets the stage for Monday. The Sunday night open will offer the first clue. Thin liquidity means volatility. Fake moves are possible. The smart approach is observation, not reaction. Let the institutions fight. If price gaps higher, expect a retest. Markets often return to breakout levels to confirm support. Chasing emotional spikes usually ends badly. Patience wins. 70 will be a battlefield. Round numbers attract defense. Expect turbulence. A pause there would not signal failure, it would signal digestion. There is always a downside scenario. Paper dumps can occur. Sudden drops can test resolve. But volatility does not change fundamentals. It only redistributes metal from the impatient to the prepared. The weekly close told us everything we need to know. Suppression failed. Demand absorbed pressure. Trend shifted. Metal is scarce. Claims are fragile. The banks are spending this weekend calculating survival. If you did your work early, you can afford to remain calm. This repricing will not be smooth. It never is. But it is underway. Stay patient. Stay disciplined. Let the system reveal what it has been hiding. The silence will break soon.